Welcome to the Byte-Size Brief. Today we are putting DOW, that's DOW, completely under the microscope. Let's get into it. When you cover the stock market long enough, you start to notice certain illusions.
Oh, definitely.
Like a company's stock price shoots up and everyone just assumes the underlying business is suddenly firing on all cylinders. But occasionally that surge is it's just a temporary reaction to a news headline.
Right. Hiding the reality that the company is actually fighting for its life behind closed doors.
Exactly. And that brings us to our mission for today's deep dive into DOW.
It is a really critical distinction to make just to set the macroeconomic stage for you all. The global chemical industry has been slogging through a brutal, deeply depressed trough throughout 2024 and 2025.
Yeah, consumer demand has been super weak.
Weak demand and profit margins across the sector have essentially evaporated. Yet against that really grim backdrop, DOW stock has shown some incredibly surprising recent momentum.
It really has.
In early April 2026, the stock actually broke its 52-week highs, trading in the $41.40 to $42.37 range.
Right, and as a retail investor, that contradiction immediately sets off alarm bells for me, like a surging stock in a struggling industry. So we need to figure out, is this recent stock surge just a temporary geopolitical blip, or is DOW successfully executing a sweeping turnaround strategy that actually positions it for a major sustainable rebound by 2027 or 2028?
Well, we should look at the external catalysts first, because they're currently what's driving the daily trading volume. Before we analyze DOW's internal financial plumbing, we have to talk about the geopolitical shockwaves hitting the energy markets.
The big headlines.
Right. The most immediate driver pushing the stock higher right now is the recent closure of the Strait of Hormuz.
Okay, hold on. Geopolitical headlines change every single day.
Right.
A strait closes, a strait opens. How does a choke point halfway across the world actually affect DOW's stock price for regular investors like me who are, just trying to look past next week? I don't want to build an entire investment thesis on the evening news.
And I agree you should never invest purely on headlines, but you do need to understand the underlying mechanics of why that headline matters to this specific company's bottom line. Citigroup just upgraded DOW specifically because of this closure.
Oh, really? Why just them?
Because the Middle East is a central hub for energy and chemical exports. When the Strait of Hormuz is blocked, a significant percentage of the world's export supply is suddenly trapped.
Okay, but DOW is a global company. Wouldn't that trap their supply too?
Not in the way that matters most. DOW's biggest competitive advantage is its North American production footprint. International chemical competitors, particularly in Europe and Asia, they rely heavily on naphtha, which is derived from crude oil. So when Middle Eastern oil gets trapped, global oil prices spike, and those international competitors see their production costs just skyrocket.
Wow.
DOW, on the other hand, runs its North American plants primarily on ethane, which is derived from cheap domestic natural gas.
So DOW is basically buying its raw materials at a local discount in Texas, while its competitors overseas are forced to buy premium imported oil.
That captures the dynamic perfectly. When the strait closes, international supply drops, global chemical prices go up to compensate. But DOW's production costs in the United States stay relatively flat.
So they suddenly have an enormous competitive advantage in the global export market.
Exactly. Their profit margins expand instantly without them having to change a single thing about their operations.
And according to our sources, it's not just the Middle East causing these ripples, right? There is another major trade dynamic shifting over in Asia that seems to be benefiting DOW.
Yes, we are seeing another substantial macro tailwind from China. The Chinese government is eliminating its 13% value-added tax export rebate on certain chemical products.
Okay, let me stop you there because value-added tax export rebate sound like an absolute accounting nightmare. What does that actually mean in plain English?
Think of it as a state-sponsored discount. Historically, when Chinese domestic demand for chemicals was weak, the government would refund 13% of the tax back to the producers when they shipped their products overseas.
Wow, so they were essentially subsidizing them.
Precisely. It allowed those companies to sell chemicals on the global market at rock-bottom prices. It's a practice commonly referred to as dumping, and it suppressed chemical prices for everyone worldwide.
So by eliminating that 13% rebate, the Chinese government is basically forcing its own companies to charge the true full price for their exports.
Correct. Chinese exports instantly become 13% more expensive on the open market. This creates a much fairer global playing field.
That makes sense. It reduces the oversupply of cheap plastics and allows companies like DOW to compete on pricing and actually capture some margin.
Exactly.
But again, these are external factors. China could reinstate that rebate tomorrow. The Middle East could stabilize next month. If I am holding this stock for the next 5 years, I need to know the business itself is structurally sound.
Which brings us to the core concept you really need to grasp if you are going to invest in the sector: the chemical cycle. This industry is notoriously cyclical.
How so?
Well, the timeline to build a new world-scale chemical plant is roughly 5 years, and it requires billions of dollars in upfront capital.
Right.
Because of that extreme lag time, supply and demand are almost never in perfect balance.
I imagine it's kind of like real estate developers building a bunch of high-rise condos. Like when the economy's booming, everybody breaks ground on a new tower.
Yes.
But by the time all the towers are finished 5 years later, there's suddenly way too many empty rooms and the rent prices just crash.
That is a very accurate analogy. Companies overbuild during the boom years, which leads to oversupply, which crashes prices. Then, because prices are so low, nobody wants to invest in new facilities.
And then demand catches up.
Exactly. During that time, global demand slowly catches up to the available supply, prices begin to skyrocket again, and the cycle repeats. Right now, we're sitting at the very bottom of a multi-year repair process. Profit margins are heavily depressed across the board.
So waiting out this trough requires a deeply resilient underlying business. Let's look at how DOW is actually performing month to month right now to see if they can survive until the cycle turns.
Okay, so compared to last quarter, what actually moved the needle here?
Let's break down the quarter-over-quarter comparison by their major operating segments. First, we have packaging and specialty plastics. Interestingly, despite the global slump, polyethylene demand and volumes actually rose sequentially.
Polyethylene being the plastic used in food packaging, grocery bags, and industrial films? Yes, the foundational building block for modern packaging. This volume increase was heavily aided by their new Poly 7 train located in the U.S. Gulf Coast.
Poly 7 sounds like a sci-fi movie, but it's actually just a production facility, right? What makes it special enough to move the needle on their quarterly volumes?
It is a next-generation polyethylene production unit. It does not just add raw capacity, it utilizes advanced proprietary catalyst technologies.
Meaning what, exactly?
Meaning they get a higher yield of specialty plastics from the exact same amount of raw material. It lowers their unit costs while increasing their output of high-value products. That new asset coming online really supported their volume growth this quarter.
Okay, but they have other segments that aren't faring so well. Looking at the notes, the industrial intermediates and infrastructure segment was sequentially down 5%, dropping to $2.7 billion. What exactly falls under industrial intermediates, and why is it dragging down the balance sheet?
This segment produces the raw chemical ingredients for things like polyurethanes, construction sealants, and industrial coatings.
So construction stuff.
Exactly. Think of the foam in your mattress, the insulation in your walls, or the clear coat on your car. This segment was heavily dragged down by prolonged global weakness in the building and construction markets.
Which makes total sense. I mean, when interest rates are hovering at multi-year highs, mortgage rates are high, people simply don't buy or build houses.
Right.
And if developers aren't building residential subdivisions or commercial office space, nobody is buying construction chemicals.
The data supports that completely. High interest rates are acting as a heavy brake on that specific segment. So when we combine the growth in packaging with the weakness in construction, we look at their overall earnings.
And what are those looking like?
DOW's fourth quarter 2025 operating EBITDA, which is a measure of their core operating profit, came in at $741 million. That was a sequential decline from the previous quarter.
But management's guidance for the first quarter of 2026 projects an improvement, bumping back up to around $750 million, right?
They do project a slight improvement, yes.
Let me push back on that, though. If they have this incredible cost advantage with cheap U.S. natural gas, and China is stopping its dumping practices, why is the profit only bumping up by $9 million? Like, why isn't it rocketing higher?
Because they are fighting a severe internal financial battle. On one side, you have the tailwinds we discussed, lower raw material costs and higher announced market prices for their plastics.
Right, pushing margins up.
But pulling them right back down are planned maintenance costs. In the chemical industry, these are referred to as turnarounds.
Turnarounds, meaning they literally have to just turn the plant off to fix it.
Yes, you cannot run highly pressurized, high-temperature chemical reactors indefinitely. Carbon deposits build up in the pipes, valves degrade, and the infrastructure requires rigorous safety inspections, so they completely shut the facility down to clean and repair it.
And I assume the lost production time makes that expensive.
Incredibly expensive. Combined with contractor labor, the costs are massive. DOW is absorbing a $125 million hit for maintenance on a single Louisiana cracker and another $75 million hit for turnarounds at their Kuwait joint venture.
Wow. That is $200 million of profit completely wiped out in a single quarter just for routine maintenance.
Yes, yeah.
So basically, it's like they found a cheaper gas station to lower their commuting costs, but their car's engine needs a total rebuild, wiping out all the savings at the pump anyway.
It is a very frustrating reality of heavy industry, and DOW's management team has realized that relying on minor quarter-over-quarter tweaks isn't going to fundamentally change their trajectory.
And they need a bigger fix.
Exactly. To truly survive the trough and thrive in the next upcycle, they need to restructure the entire company.
Which introduces the Transform to Outperform program. I was reading through the source materials on this, and it's a massive undertaking. They're trying to squeeze out a staggering $2 billion in near-term earnings improvement.
The sheer scale of the program is notable. Announced in late January 2026, the target breaks down to roughly 2/3 coming from pure productivity gains and cost-cutting, and 1/3 coming from new strategic growth initiatives.
And the human cost of this program is severe. To hit those productivity numbers, DOW is cutting 4,500 jobs globally.
Which is significant.
That is roughly 1/8 of their entire workforce. And the financial cost just to implement these cuts is equally staggering. I mean, they are projecting $1.1 billion to $1.5 billion in one-time costs, with up to $800 million of that going exclusively to employee severance packages.
It is a heavy upfront expenditure designed to lower their baseline operating costs permanently.
But here's what I don't get. They are spending over $1 billion right now, during the bottom of a cyclical trough, when cash is super tight, just to maybe save money later.
Yeah.
And the sources mention that artificial intelligence is a major driver of these future savings. Honestly, how does a chatbot run a heavy industrial chemical plant? It sounds like they're just throwing AI buzzwords into the press release to keep Wall Street analysts happy.
I totally understand why you would be skeptical. When the general public hears AI, they think of large language models writing emails or generating images. But in an industrial context, it is entirely different.
Okay, how so?
It is about end-to-end process automation and predictive maintenance. Let's look at a highly tangible example from the company's operational updates regarding those expensive plant turnarounds we just discussed.
Right, I'm listening.
When a chemical plant is shut down for inspection, companies historically had to spend millions of dollars and weeks of labor constructing complex metal scaffolding systems.
Oh, right.
They had to build these temporary structures 10 or 20 stories high just so human inspectors could climb up and visually check the pipes and distillation columns for microfractures.
Which sounds incredibly dangerous and time-consuming.
It is both. Now, under the Transform to Outperform program, DOW is deploying AI-piloted drones and robotic crawlers to conduct those inspections.
Wow, really?
Yes, the drones fly up, scan the infrastructure, and feed high-resolution visual data into a neural network trained to detect corrosion or weld degradation. They entirely eliminate the need to build the scaffolding.
That is wild.
They eliminate the physical safety risk to human workers. What used to take 3 weeks and hundreds of contractors can now be completed in an afternoon.
Okay, wow. When you frame it like that, literally erasing a multi-million-dollar scaffolding budget from the balance sheet with a single drone flight, the AI angle actually makes total financial sense.
And the automation extends to the corporate offices as well. DOW is utilizing AI for heavy legal discovery and complex patent research.
Right, cutting down on lawyers.
Exactly. By automating the analysis of thousands of technical documents, they drastically reduce the billable hours they have to pay to third-party law firms.
Yeah.
The billion-dollar upfront cost for this entire program is essentially the price of rewiring the company's DNA so it runs leaner permanently.
It makes sense long-term, but rewiring DNA costs a fortune today.
Yeah.
Which brings us to perhaps the most painful part of this deep dive for our listeners who rely on passive income. To fund these severance packages and weather this cyclical trough, DOW had to make a brutal decision regarding its cash flow back in July of 2025.
Yes, you are referring to the dividend cut.
Yes, the income investor's absolute nightmare. They slashed their dividend by 50%. This situation is a textbook example of what is known in the investing world as A dividend trap.
A classic trap, yes.
Prior to the cut, DOW's dividend yield had artificially spiked to over 10%. Retail investors saw that double-digit yield and thought they were getting an amazing bargain. But the yield didn't spike because the company was generously increasing the payout.
No, not at all. The yield spiked because the underlying stock price was dropping like a stone.
It is purely a mathematical illusion. Dividend yield is calculated by dividing the annual dividend payout by the current share price. If the dividend payout stays exactly the same, but the stock price falls by half, your yield doubles on paper.
But the underlying business is actually deteriorating.
Exactly.
Now, after the cut, the annual payout sits at $1.40, yielding a much more modest 3.38%. It burned a lot of retail investors who thought they had locked in a safe, high yield.
While it was undeniably painful for income investors, objectively looking at DOW's balance sheet, the cut was a mathematical necessity.
Why is that?
At the time of the cut, their trailing 12-month earnings per share was deeply negative, minus $3.70. Before they reduced the payout, their dividend payout ratio was nearly 180% of their actual earnings.
So they were paying out almost double what they were actually bringing in the door. You can't fund a payout from empty pockets forever without taking on dangerous levels of debt. Exactly. The dividend was bleeding their free cash flow completely dry. And alongside the dividend cut, management took aggressive steps to fortify their cash reserves.
What did they do?
They raised $3 billion by selling a 49% equity stake in their U.S. Gulf Coast infrastructure assets to a firm called Macquarie.
Wait, what does selling a stake in infrastructure actually mean? Did
Yeah.
they sell off the actual chemical plants?
No, they sold a minority stake in the supporting logistics, the pipelines, the storage terminals, the loading docks. It is a common strategy.
Okay.
You can think of it like selling the plumbing of your house to an investor and then paying them a fee to continue using it. It instantly generates a massive lump sum of cash.
Smart.
On top of that, DOW executed $2.4 billion in new bond issuances, strategically pushing their next major debt maturity all the way out to 2029.
So DOW took the bitter medicine early. They cut the dividend to stop the bleeding, sold off a piece of their plumbing to raise cash, and took on long-term debt now, so they wouldn't end up on financial life support later while waiting for the broader chemical cycle to finally turn.
They bought themselves a financial runway. And that naturally requires us to examine where DOW is actually allocating this newly secured capital for the future.
Right, because a company can't just shrink its way to greatness. Eventually, you have to grow the underlying business.
True, but before you can grow efficiently, you have to trim the dead weight. DOW's current strategy relies heavily on asset rationalization.
Which means what exactly?
This means permanently shutting down inefficient, high-cost manufacturing plants that drag down their overall profit margins. For instance, they just closed a propylene oxide unit in Texas.
Just to ground this for the listener, what is propylene oxide actually used for?
It is primarily used to make polyurethanes, the flexible foams used in memory foam mattresses, car seats, and furniture.
Oh, tied back to construction and autos.
Exactly. As we discussed earlier with the high interest rates, the housing and automotive markets are currently sluggish. Because demand for foam is down, DOW took 20% of the entire North American industry capacity for propylene oxide completely offline.
Oh, 20%.
The plant was just too old and too expensive to run at partial capacity.
And it isn't just happening in North America. The sources show they are shuttering 3 higher-cost European plants as well, including a basic siloxanes plant in the United Kingdom. Why target Europe specifically?
Europe is dealing with severe structural energy cost issues. Prior to recent geopolitical conflicts, the European chemical industry relied heavily on cheap pipeline gas from Russia.
Right.
With that supply largely shut off, Europe is now forced to import liquefied natural gas on ships, which is inherently much more expensive. DOW is simply cutting its losses in a region with structurally high energy costs to focus its capital on its heavily advantaged assets located in the Americas.
That makes strategic sense. But while they are cutting the old, inefficient stuff, I noticed they are also intentionally delaying their brand new stuff. DOW announced a 2-year delay to their highly anticipated Path to Zero project located in Alberta, Canada.
Yes, this was supposed to be their crown jewel, a state-of-the-art, low-carbon ethylene cracker designed to produce plastics with net zero carbon emissions.
But now, the Phase 1 startup is pushed all the way out to late 2029. Does this mean they are giving up on their sustainability goals, or are they just totally out of cash to actually build the facility?
Looking at the analysis, it is neither. It is a highly strategic market timing move. Remember the chemical cycle we mapped out earlier? The boom and the
Right,
bust.
overbuilding of the condo towers, right.
Right. If DOW brings a massive new production facility online at the absolute bottom of the cycle when market demand is already weak, they will flood the market with even more supply.
Which crashes the prices further.
Exactly, and ruins their own profit margins. Management wants this new capacity to hit the open market right as the chemical cycle is peaking, which industry models suggest will be around 2029 or 2030.
Ah, so they are intentionally delaying opening day so they can sell their new products into a hungry, constrained market rather than an overfed one.
Precisely. The financial fundamentals of the project haven't deteriorated at all. The Alberta project still projects an 8 to 10% base return on investment, with roughly 30% of the capital expenditure already spent. Furthermore, there is an unmodeled upside here that the baseline financial projections don't even include. It is called the green premium.
All right, what exactly is the green premium?
It represents an estimated 100 to 200 additional basis points of profit. In simpler terms, that is an extra 1 to 2% profit margin.
How do they get that?
Major brand owners, the companies making the actual soda bottles and shampoo containers, have aggressive corporate climate goals. The expectation is that they will be willing to pay a premium price for low-carbon, decarbonized plastics to meet those targets.
That's fascinating. So the delay isn't a failure. It is actually a calculated pause designed to maximize the return on the billions of dollars they are investing. Let's pull all of these complex threads together for you listening.
It's a lot to process.
It is. So DOW is a massive industrial company enduring a deeply painful cyclical trough. They are bailing water by making brutal cuts to their global workforce and slashing their dividend in half. But at the exact same time, they're catching a sudden geopolitical tailwind from the Middle East that boosts their margins, and they are radically restructuring their operations with AI and drone technology to emerge much leaner on the other side.
That captures the duality of their current situation perfectly. And if we look at the long-term view from the retail investor consensus, if DOW successfully navigates this trough and achieves that mid-cycle margin recovery to around 15% by the year 2030, base case estimates point to a share price fundamentally valued in the low $60 range.
Which is a huge jump.
It represents significant potential upside from today's trading prices, assuming they execute flawlessly on this highly complex restructuring mandate.
And assuming that the global economy actually cooperates and demand returns, of course. But before we sign off, I want to leave you with a thought that goes beyond just DOW's balance sheet.
Go for it.
If every major industrial company eventually adopts this kind of AI process automation using drones instead of scaffolding, algorithms instead of lawyers, does that operational cost advantage just become the new baseline? Like, if everyone is cheaper to run, does that force chemical prices down even further? Or does it actually fundamentally cure the boom and bust cycle that has defined this industry for a century?
It is a profound question that will redefine the entire manufacturing sector over the next decade.
All right, listeners, what's your take on the future of DOW? Are you bullish on their AI-driven cost cuts and geographic advantages? Are you bearish because of the heavy debt load and dividend cuts? Or are you sitting on the fence waiting for the cycle to actually turn before putting your money to work? Let us know in the comments. See you next time on the Byte-Size Brief.